let's get in Rishi Sanghvi, MD of Sanghvi Movers, to talk about these orders and the outlook for FY25 ahead. Rishi, great having you. Thanks for taking the time out. I hope all is well. I'd love to talk about a few things, Rishi. Firstly, congratulations on these orders. Can you fill us in on whether the order inflows in Q1 thus far have been at par with what you'd have anticipated, or have things been slow because of the election period?
Good morning, Neeraj, and thanks for having me. The order book is actually looking very healthy. We are very bullish on this year, notwithstanding an election and monsoon period. We foresee that we will outpace our top line for last year.
Okay. So this 180 crores order win, one is from an IPP, I believe, which is largely in line with what your recent orders or past orders or business line largely is, and correct me if I'm wrong here. But interestingly, there is an EPC order too out there. I thought power was a buzz and your hands would be full. Why get into EPC, which is maybe a newer line, maybe lower margins than power per se? Why do that, Rishi? Why this diversification?
So the order comes from an hydrocarbon sector, and it's a new business segment for us. The primary reason for us to enter into construction services for both refineries and the renewable wind energy sector is that there is a tremendous opportunity and a lot of demand from our customers. They are pulling us in, looking for a well-established, well-run company. And while the margins on the construction side of the business are lower, we believe that there will be significant volume play and a large number of demand that should make the space very interesting for us.
Rishi, hi, it's also Samina joining in. So Rishi, we understand then the EPC business is largely a volume play, which will make good the margins. They may be slightly lower than your traditional business. How much does EPC currently contribute to your top line, and where do you see that over the next 2 to 3 years?
Hi, Samina. Good morning. So, this year we believe that the crane business, which is our core, where the margins are around 60% EBITDA, will land around 600 crores. And the EPC business will add another 400 crores to the top line. So we believe we'll end this year anywhere between 950 to 1,000 crores.
That is top line across the board, about 1,000 odd crores. Rishi, is that a fair expectation? And is that the kind of growth rate you'd be working with over the next 2 to 3 years as well?
Well, we definitely see that this year. And going forward, we hope to build up on that momentum. We have been growing around 25 to 30% the top line for the last 3 years.
Rishi, I mean, your margins in your business are phenomenal, to say the least, and I guess that's what explains why you're in it and why we are talking to you and why investors are also very pleased. At margins at about 63% versus 59% that we've seen, how sustainable is this, especially given that the weightage or contribution from EPC is expected to go up in the next couple of years? What is the margin range that you would be comfortable with?
So on the crane business, which is our core and I believe will constitute anywhere between 60 to 65% of our top line for this financial year, we are confident of maintaining last year's margins. On the EPC side, of course, it's a volume business with lower margins. So we expect to end up anywhere between 10 to 15% on the EPC side.
So what would console margins be like, Rishi, based on the growth that you anticipate for each of these segments?
It would be anywhere between 35 to 40%, because again, it's 400 crores in EPC at 10% and about 60% on 600 crores on the crane business.
Right.
Sorry, Rishi, just so that I don't get this wrong, okay, I'm just trying to reiterate this. When I looked at your numbers, your console numbers for FY24, right, or TTM, the operating margins console were about 63%, if I'm not wrong, for FY24.
That's right.
Now you are saying that your margins will go down to 40% from the 63% because of the change in mix.
Yes, but yes, you're right. But the base itself is much larger. We're going from 620 to 1,000 crores.
Yeah, agree. But
So we'll
because
do about 360 on the crane business and about 40 to 50 crores on the EPC business. So on a consolidated blended, we would be around 400 on a 1,000 crore base.
So Rishi, why the focus so much more on top line as opposed to bottom line? I mean, that's a huge cut on margins, even though we completely get that your focus remains on growing revenue.
It's not only on growing revenue, this is where the sector is headed. For example, in the renewable wind energy space, there is a severe shortage of well-established construction players who can service the independent power producers. OEMs have stopped putting up projects, and very few OEMs, Suzlon to a large extent, maybe Inox, are putting up turnkey services in the wind industry. And the independent power producers do not have the capacity or ability and the bandwidth to undertake the construction space. So there's a massive white opportunity there. For example, in the renewable space, we have a 10 gigawatt inquiry pipeline as of today. And we're extremely bullish on how the sector is going to shape up, not only in this financial year, but going forward. We have started adding value-added services in and around our crane business. So we undertake the complete mechanical, civil, electrical, surface logistics, which is the complete balance of plant activities for the renewable wind space. So on a 10 gigawatt order inquiry pipeline, and with the way the renewable energy sector has positioned itself and will continue to grow over the next few years, we believe that this is a very exciting space for us, will add a lot of value to the company, and we believe that we can create a lot of value for our customers.
Rishi, sorry, I'm just digressing a bit because what you're saying gives us lead indications into what other businesses might also do. Sorry, did I hear you say that except for Suzlon and Inox, there aren't enough players putting up capacities? And is there a bit of a red mark because the targets are very lofty? The con calls from both Inox and Suzlon seem to be very constructive about the capacities that they will come up with and the execution that they will do. You are saying beyond that there isn't much happening, but within this itself... Sorry, please.
Yes, because the other OEMs are more interested in product supply rather than project execution.
Okay.
So, the international OEMs are not too focused on delivering turnkey EPC projects to their IPPs.
Got it.
So there is a massive white space in this space. There are a lot of IPPs which are fund-backed, sovereign funds, pension funds, private equity funds, and they don't have the bandwidth to execute turnkey projects.
Got it.
So there's a great opportunity for a player like ourselves to deliver the complete balance of plant scope to renewable players. And that's the exciting space that we are focused on capitalizing on going forward.
Okay. Rishi, just a follow-up to the other question that you therefore then. So let's assume you're tapping this white space. I heard you say that that's where the industry is moving. So you'll probably settle down at 40% margins, but you'll get top line growth. I just did a back of the envelope calculation. On a 600 crore top line, if you did 63% margin, you ended squarely about 370, 380 crores of EBITDA. On a 1,000 crore top line, you do 40% margin, you end up squarely around those levels. So for FY25, you will show top line growth, not EBITDA growth, but that will set the base for the next year. Do you expect?
Absolutely.
So do you expect another year of very high top line growth in FY26 as well?
So primarily what we are trying to do is we are consolidating services for the IPPs. And going forward, we will be bringing in some of the services that we offer our customers in-house. So it will be a year of, because this is a new business, it has a gestation period, our operating margins will not be as high as they would traditionally. But going forward, we will reach a certain scale, we will be able to bring in capabilities in-house, and that will drive down our costs and build up our margins going forward.
Rishi, just taking a cue from those numbers, I believe currently utilization stands close to 83-84%. If you're looking to significantly scale your top line, as we understand, from this conversation, I'm assuming there'll be aggressive expansion plans on the cards. You want to walk us through what is lined up in the next, by the end of this calendar year and maybe in the next year as well, and how do you plan to fund those expansions? Because I believe you're still sitting on some debt on your books.
Absolutely. So, in the last 4 years, we have done about approximately 950 crores of Capex. And we are only at a net debt of almost 250 to 280 crores. So we have been able to manage our expansion primarily through debt funding, with 30% of the margin being funded through internal accruals. We are also sitting on a significant cash surplus on our balance sheet, which is to the tune of about 150 to 170 crores. So in this year, the board has approved for FY 24-25 a capex plan of about 150 to 200 crores. But looking at the demand that there is in the market, our inquiry pipeline, and the way that the economy is performing, I do believe that we may have to go back to the board for further approval of capex.
Right. And when do we expect these fundraising plans? When do you plan to go back to the board and discuss these fundraising plans?
It would be subject to how things pan out in the third quarter.
Okay. Rishi, I have one final question. I don't know, I don't have a handle on what the follow-ups were to this proposal, I believe, that was laid out after the results of increasing the directors' compensation. But I do know that there was a to and fro and a feedback that you had received and you had asked for from investors about the proposal. Where are we there, and is there a rationale for whatever decision you've arrived at? Because it was a fairly stiff increase, I believe, in directors' compensation.
Right. So Neeraj, I am the promoter of the company, and it would not be right for me to speak on this topic because I am the interested party. But the increase in the compensation for the managing director was approved by the Nomination and Remuneration Committee and approved by the Board of Directors. The proposal will now be put up in the annual general meeting where all the shareholders will vote on it. But the rationale that the board and the Nomination and Remuneration Committee had was that this was a phenomenal and historical year, FY 24, and the company has delivered significant and historical numbers. And they thought it prudent to compensate the management for the performance that the company has delivered. So the proposal has moved through the appropriate channels and will be put up towards the shareholders in their annual general meeting.
Very lastly, Rishi, while we've of course had a very extensive conversation, very lastly, on your order book, which is at about 426 crores, what is the timeline for execution and closure of that order book? And what is the quantum of orders that you're currently bidding for? When can we expect some order wins from your stable?
Right. So actually, our order book today stands around 600 to 650 crores. And the way we disclose our order book is that the entirety of it is to be executed in this financial year. So we believe that we are on track to surpass last year's numbers, as I have already indicated. And we believe that we have a very healthy inquiry pipeline, which will translate to significant orders within this financial year.
Thank you. Thank you very much, Rishi. It was such a pleasure to talk to you, get an understanding of what's happening in the industry, what's happening in Sanghvi Motors. Good luck. It looks promising. I hope things play out as expected, and we will talk to you once you report earnings in the quarter. But until then, good luck and see you soon.